You're listening to the Ticker Podcast from IR Magazine, a roundup of this week's leading stories and industry comment from the world of investor relations. Here's your host, Jeff Cossette.
Hi, everybody. Who decides? Who decides what movie to watch? Or what a piece of art is worth? Or what work is worth? Or who gets the COVID vaccine? Who decides who our leaders should be? These sorts of questions do keep coming up. I think the answer is obvious. It's me. I should decide. Basically everything. Things would be so much better. Socially just, environmentally sustainable society for starters. Alas, even in this time of crisis, I am unlikely to seize power. So who? Who is going to engineer a better world? Governments? Regulators? My guest today thinks not so much. Brian Matt is Director and Head of ESG Americas for information purveyor IHS Markit. He says governments just don't have the wherewithal to tackle issues like global warming. Instead, Matt says capital markets will be, even already are, the driving force for change. Now, whether global capital markets can really capture the expectations of society is one question. Less in question, however, is that capital markets are fast reshaping themselves to meet new sorts of investor expectations. Matt says ESG and sustainable finance are COVID-supercharged megatrends, and they'll radically shift how companies are valued, how boards operate, and how corporate communication and engagement will be conducted in the years to come. On this Ticker Podcast, Brian Matt on the acceleration of ESG through a crisis. Brian, in a recent IHS Markit research paper, you argue that any sustainable green recovery can only happen with an acceleration of ESG. One where you think that capital markets, presumably as representatives of society, will be the driving force. Is that the correct thesis?
Yeah, it's a good summary of it. I'd say internally at IHS Markit, we have a number of different business lines, experts that focus on different different client types within the technology space, within transportation, within healthcare, and then more generally out into the financial markets. And I think really after conversations with that group, that's what we came up with just from each of them talking to their various constituencies was that really capital markets stands to really drive any type of sustainable recovery out into the market, just given that there are both public and private funding sources that are increasingly looking at companies and investments and where we head in the near future with an ESG lens. I think there's a lot of ways that manifests into different businesses, different companies, but in the end, both from public financing, from some of the EU green recovery proposals, as well as from private financing aspect. That's really where investment is driving, and all of the rebuild that we see as we start to put the economies of the world back together is going to have that lens applied to it.
Yeah, and obviously it's no secret tons of money is going into so-called ESG funds. And this question of greenwashing, of course, we can get into that. But I'm sorry, I want to back up. Before we started recording, you mentioned Milton Friedman, and I want to know, why was he wrong? Why doesn't he work now?
Yeah, it just happened to be the 50th anniversary of the shareholder primacy statement. So we've discussed this a few times. Milton Friedman's system that was built around treating one stakeholder as primary over other stakeholders maybe just doesn't operate well in the type of communications and transparency environment that you need to have today. It's very difficult for any company to make decisions that benefit one stakeholder but hurt other stakeholders in a public sense. It's just not as easy to do as the world has become much more transparent. You really do, as a large company, need to identify who are all those potential stakeholders, the ones you speak to every day today, as suppliers, customers, employees, but also then communities, regulators, society as a whole. All of those that may not have an immediate voice, but the work that you do has an impact on. You start to see some of the impact of poor decisions to value one stakeholder over another in the news every day. You can almost take each section of the New York Times or the Wall Street Journal each week and get back to decisions to choose one stakeholder over another. I think most management teams have gotten a lot smarter about that over time, and boards are now starting to step in with really the requirement to make sure that all stakeholders are treated effectively in the process of building a business.
True. Yeah. But you're actually kind of almost arguing for a new deal, right? Between Wall Street and society, essentially. And I don't know, you're hoping that Wall Street, which to date, I don't know, doesn't seem to reflect society's wishes or necessarily, or.
Well, let's step back to asset owners and their relationship to asset managers. Asset owners, you and I have our own individual accounts. We may own mutual funds, ETFs, etc. We may have a pension fund if you work for a company that offers a defined benefit pension plan. There are increasingly more options for us as individuals or as institutions to express our values through investment. You saw BlackRock launch a whole series of new portfolios this year, just back in January, alongside Larry Fink's release. That again tries to meet all of those possible goals. You see a set of impact portfolios that are being launched by some of the large asset managers that are expressly designed for you to find your values and be able to express them through your investments. The point is that the capital markets become almost an evaluation process and an allocation of capital towards those values from asset owners. In the end, you'll see, in some cases, regulators are making that process easier in Europe, trying to encourage companies to offer more investment products that allow you to express those values. I don't see that declining or reversing itself at any point in time. There are going to be more options for individuals to express their values through investment. The companies seeking to raise capital or seeking to trade on secondary markets with their existing securities need to be able to present themselves and their story to make sure that capital is allocated towards them as opposed to away from them. Does that answer the question? I think that's how I see things just from watching capital flows here.
Well, that's the idea, right? Capital markets are supposed to reflect the expectations of society, or at least.
Yeah. And they have more vehicles to do that today than they ever have at any point in time.
Fair enough. And government, you argue, is at the moment ill-prepared for that role.
Again, sitting in the U.S., I would say our government has not been prepared for a lot of things. Our Securities Exchange Commission, some of our regulators have not been as forceful as European or sometimes even Asian regulators in terms of pushing disclosures from companies or those seeking to raise capital. But that said, while there's no de jure requirements, investors themselves become the de facto deliverer of that message. What Larry Fink says around potentially 10 to 12% of shares outstanding of many large public companies is what's going to drive decisions in the boardroom if a regulator or a legislative body is not.
It is kind of the debate of our time, isn't it? I mean, and by time I mean the last couple of hundred years, just sort of the modern time, government versus kind of a market. So then COVID wraps into all this, the momentum of this catalyst for ESG acceleration and societal acceleration. Can you talk about that?
COVID was something that showed how companies dealt with risks effectively. COVID was probably the ultimate risk that a board or a management team should, in theory, be able to prepare for. And you started to see companies that had prepared effectively and were able to transition their business models over, some very quickly, some less quickly. Really, the focus on safety for employees, for customers, for supply chains. That first focus on safety, while it existed out there for companies, it now became the primary focus in the boardroom starting in March, April, and May, as board members started to reorient themselves to how to operate in a COVID world. There's safety is, of course, one of the primary focuses of evaluating a company from a social perspective. That was the start of the process. Then, of course, everything we saw around the murder of George Floyd, the protests in a lot of large cities across the country and across the globe, a focus on social issues, a focus on diversity. While it existed out there, this was simply an accelerant. Companies understood previously that they needed to take diversity and inclusion into consideration. Many of them got off the sideline and started to act as they saw what happened after the murder of George Floyd.
Yeah, it really is. People I speak to, the corporate secretaries and IR people, a lot of them actually, a surprising number, some of them are hep, but are seeing this kind of stuff really almost for the first time, actually considering it. Because again, I hesitate to call it like a phase shift or a paradigm shift, but maybe it's getting through after all these years.
ESG risks are extra financial risks and eventually can become financial risks. You saw some of those risks become financial risks this year when it came to employee health and safety. But also you see that as companies rebuild their supply chains and potentially may have to shorten up supply chains to maintain access to everything that they need to operate their business. There are a lot of decisions made this year very quickly. And in general, I think business has been pretty resilient and been able to make those moves. But each one of those decisions is taken in the context of we can't operate the same way we did in 2019. We are going to change, and if we're going to change, let's make sure we look at all the externalities that exist out there for our business and make sure we address those externalities effectively.
Yeah, it's really changing the way how IR people, kind of do their job. If valuation of companies is really changing so dramatically and so quickly, it's a sea change.
100 years ago, we came up with a definition of what is revenue, what are assets, what is cash. And we've built that into financial accounting standards over time. We're just in the infancy of doing that same process with non-financial information and all the different reporting frameworks and industry initiatives that are doing that are contributing to, hopefully in the end, a stronger understanding and a way to really put your finger on what are all the externalities that don't sit on your financial statements today. How do you measure them? How do you address them and attack them appropriately?
Yeah, and in your paper, you look at a bunch of scenarios that essentially are premised on this new valuation method. And one of the scenarios is basically, if I'm reading it right, kind of a wholesale repositioning of the investment management industry.
Yeah, I went through, we did a separate webinar focusing on pieces of this. I covered each of the items on Spotlight on Social Factors, Rise and Repositioning of Sustainable Investing. Again, each one of those that you see on page 39 really step back to different ways that that each investor is trying to operate, each asset manager is trying to operate in a world where they need to offer more of those investment vehicles that include values and be able to compete for capital against against other investors. The Larry Fink and SSGA and other large investors that have been in the sustainable investing market for some time are the primary competition for some of these smaller asset managers that are just starting to roll out their own views of how should we evaluate portfolios on sustainability, on social factors, on governance. Some of those companies are newer to the game and maybe need to differentiate themselves in some way from the larger legacy providers. It's really that process that I think has changed the most. You can go to UNPRI's disclosures and take a look at what what investors have reported as to their staffs that are involved on dedicated ESG investing. Just about every investor has increased that staff, some more than doubled the size of those staffs internally, because they know they need to do this type of work on ESG integration to fulfill what their large institutional clients are looking for, and to be able to compete with the larger and more established names. That process and how it's then affected the rest of the way into the shareholder base, into not just your top 10 investors, but maybe your top 50 or top 100 investors as a company, is what we're seeing today. Many of those smaller investors are just starting to and learning how to evaluate companies. And it's a good opportunity for companies to tell their story to those investors as well.
Yeah, I agree with you. That is kind of the section of the market that's due for the most shakeup. I'm speaking with one fund manager in a week or two who they try to differentiate themselves by they listen to all the rating agencies, the ESG rating agencies, but they have something in house. But they also have this very sort of active engagement style where their staff is I don't know, quadrupled just in the last 6 months all over the world looking at that. They're almost acting as kind of advisors almost to boards and management about the kind of risks they face that they may not have considered before.
Yeah, any public company at this point above a certain size should know. We talked earlier about stakeholders. You should know who your stakeholders are. You should also know what do those stakeholders consider material issues. And then, what do you as a company consider material issues? What's the overlap between those? That materiality exercise is now performed by most large companies. A lot of smaller companies are just starting to do it for the first time. Shareholders are one of those stakeholders, and probably one of the more important ones, given the alignment of interests. Shareholders often raise, this is a particular issue that I think you as a management team or a board need to be thinking about and prepared for. Sometimes that information goes right to management, to board, to make those decisions. How are we going to prepare for cybersecurity, for social risks, for diversity? Each of those type of things. If it comes from shareholders, because of the alignment between the company and management and the shareholder, hopefully that's a good place for those risks to be spotted, brought into the company, and addressed.
Huh. You mentioned a little earlier, Matt, I think you mentioned the phrase required disclosures. Just to kind of wrap up, what do you think of the effect of the U.S. election, a Biden administration? How's that going to change the landscape?
Boy, hard to tell. The existing SEC as it stood seemed fairly aligned against any type of required disclosures. The one exception, of course, was around human capital, which did make it into rulemaking earlier this year. I think companies will now start to have to disclose in Form 10-K their approach to human capital just on a principles basis. We'll see where things go down the road. I think if you read that CFTC report that was published, about a month ago or so, that's the first time we had seen a government regulatory agency openly step out and call for things like a price on carbon, required disclosures from companies. That's new to the U.S. system, although it's fairly standard across European and sometimes even Asian regulators. I think we will see a tilt towards maybe being a bit more prescriptive as U.S. regulators over time. And sometimes some of what those regulators are looking for is sitting in that CFTC report. It is a bit of a roadmap for where we could be headed. Again, companies should be an important part of that. Each company should know, again, what its material issues are and what it should be disclosing. Companies should be an important piece of coming up with, if there is to be any further requirements, either principles-based or rules-based. Generally, rulemakers and regulators do that with the input of companies, not just directly rolling over them. They should be considered and included in the decision-making process. And generally, you've seen SEC, CFTC, and others open to that type of dialogue.
Well, I'm sure they will be having a lot of that dialogue in the very near future. Brian, Matt, thanks for joining us on the Ticker.
Thank you so much, Jeff.
And that's your Ticker Podcast. My thanks to IHS Markit's Brian Matt. And you may have caught wind, S&P Global says it wants to buy IHS Markit in a deal worth over $44 billion. Sounds to me like this whole non-financial financial information craze may have some staying power. Still, not sure if shareholders should be deciding not only their own, but everyone else's best interest. As I mentioned at the top, that job should be mine. Thanks for listening. In Montreal, I'm Jeff Cossette.